Welcome to the deep dive. We're here to cut through the noise and give you some truly actionable insights. Today, we're taking a close look at Tilray Brands, Inc. That's ticker TLRY. Specifically, their Q4 2025 earnings report. Our mission, as always, is to get past the headlines, the market chatter, and give you a clear, really comprehensive understanding of what actually happened this quarter. And maybe more importantly, what it means for Tilray going forward. Now, if you've seen the news, it might seem like a bit of a mixed bag. Tilray had this significant beat on adjusted profitability. Sounds great.
Right.
But they also fell short on revenue expectations.
Right.
So how do you square that? How does a company post like a massive loss but also beat profit estimates? It's a bit of a head scratcher.
It is, definitely.
And that's the paradox we want to unpack for you today. We've actually structured this whole analysis into 5 distinct parts. It's a clear framework to guide us through the numbers, the strategy, and what management is signaling for the future. Okay, let's kick off our analysis. Now for slide 1, the at-a-glance scorecard.
The at-a-glance scorecard.
So when you first look at Tilray's headline numbers, you see adjusted earnings per share, EPS, of 0s and 2 cents. That handily beat the Wall Street consensus. They were expecting a loss of 3 cents a share.
Yeah, a clear beat there.
Definitely a win on that front.
Yeah.
But then total net revenue for Q4 came in at $224.5 million.
Sure.
And that missed the consensus forecast, which was closer to $240 million.
Right, hence the mixed reaction.
Exactly. You can imagine analysts were sort of scratching their heads a bit initially. But here's where it gets really wild and potentially alarming if you're just glancing at the year-over-year figures, the OI stuff. Total revenue, like we said, $224.5 million. Just a slight dip, 2.3% from last year. Okay, seems manageable.
Mm-hmm.
But then you hit net income, or loss, attributable to shareholders, a staggering negative $1,272.8 million. That is a colossal decline, like minus 3,909% from a $31.7 million loss last year.
Wow.
And the diluted earnings per share, that came in at negative $1.30, a breathtaking minus 3,150% YoY decline. So, I mean, for those of us maybe not digging into the footnotes immediately, these numbers just scream catastrophe, right? What are we looking at? Is the company in free fall?
Yeah, it's an excellent question. And that stark difference, between a small revenue dip and those huge percentage drops in net income and diluted EPS, that's exactly what we need to understand. And no, the short answer is it's not an operational collapse. Those percentages, while, terrifying at first glance, they aren't really telling the story of the company's core business performance this quarter. Instead, this massive difference is driven by 2 very specific, though pretty significant factors. The first one, and really the main driver of that huge loss gap, is generally accepted accounting principles, the official numbers, was a massive non-cash accounting charge.
Non-cash, okay.
Right. Tilray reported that net loss of over $1.27 billion, but almost all of that, a stunning $1.4 billion, was actually an impairment charge on goodwill and intangible assets. So think of it like this. Imagine you bought a house back in 2021, betting on a huge immediate neighborhood boom that just hasn't quite happened yet at the speed you expected.
Okay.
This charge is kind of like adjusting the value of that house on your personal books to reflect today's market realities. It's them saying, okay, the value of assets we got from the AFRIA merger back in 2021, which were based on hopes of U.S. cannabis legalization happening sooner, well, those hopes haven't fully materialized yet.
So it's an accounting adjustment.
Exactly, an accounting adjustment. It reflects a change in their long-term assumptions about the value of stuff they bought years ago. It's not cash flowing out the door from this quarter's operations. That's crucial. Then the second factor hitting those per share numbers is share dilution. The weighted average number of diluted shares outstanding went up by a pretty substantial 23% year over year.
Right, more shares.
Yeah, so that big net loss, which again was mostly that non-cash charge, gets spread across way more shares. That naturally pulls down the per share number and, reduces each shareholder slice of the pie percentage-wise. And just quickly, analysts typically use diluted EPS because it's more conservative. It accounts for things that could become shares. It's the standard, even if it looks, well, pretty startling in this particular case.
Okay, so not the company suddenly hemorrhaging cash. It's more like the accountants doing a major reevaluation based on how the market, especially U.S. legalization hopes, actually played out.
Yeah.
That definitely put those scary numbers in context. Let's keep digging. Moving past the headlines then, let's dive into what's really driving their profitability. Moving to slide 2, the engine of profitability.
The engine of profitability.
The engine of profitability. All right, let's shift focus now to Tilray's profitability metrics. because this is where that huge non-cash impairment charge really throws into relief the growing difference between their official GAAP results and their adjusted non-GAAP performance. So for the fourth quarter, gross profit actually fell. It was $67.6 million, down from $82.4 million last year, and the gross margin shrank too, down to 30% from 36%.
Wow.
Now we'll get into why in a second, but that dip was mainly driven by challenges in their beverage segment. But interestingly, if you look at the full fiscal year 2025, the picture looks better. Gross profit actually went up 8% to $240.6 million, and the gross margin held steady at 29%. So it kind of depends on your time frame.
And that nuance is really important
Yeah.
because when you look at operating expenses, they just exploded, right? $1.51 billion. That resulted in this staggering operating loss of negative $1.44 billion. Huge. But again, it's crucial to remember this number is almost entirely skewed by that $1.4 billion impairment charge we just talked about. Take that out, that one-time non-cash hit, and the operating loss would have been far smaller, much more in line with what you'd expect, and it gives you a clearer view of their actual operational spending for the quarter.
Right. So the really telling story this quarter, like you said, is that sharp contrast between the GAAP and the non-GAAP numbers. Tilray reported a GAAP net loss of $1.27 billion massive number. But then on an adjusted basis, they actually posted a profit, a non-GAAP adjusted net income of $20.2 million. So the difference, the bridge between those two is basically just pulling out that non-cash impairment charge.
Exactly. That's the lion's share of it. And this is why metrics like adjusted EBITDA are so critical, especially in industries like cannabis, where these big non-cash items can really warp the official GAAP picture.
Right, EBITDA, earnings before interest, taxes, depreciation, and amortization.
Yep. Management uses adjusted EBITDA as a key indicator of their core operational cash flow. For Q4, their adjusted EBITDA was $27.6 million. Now, that was a slight dip, about 6%, from $29.5 million last year. But this metric, which also strips out the impairment, suggests that, yeah, the company is generating positive cash from its core operations, even if there are still some pressures from investments and some of those segment-specific challenges we mentioned. And circling back to that massive impairment charge, while, yeah, it created a huge GAAP loss on paper, you can actually look at it strategically as kind of clearing the decks.
Clearing the decks, okay.
By writing down the value of that goodwill and those intangible assets on their balance sheet now, Tilray significantly reduces the amount of non-cash amortization expense it'll have to record in future quarters. So this accounting move, even though it's painful short-term because it kind of reflects badly on what they paid for EFRIA back then, it already makes it mathematically easier for them to report positive GAAP net income down the road. It's a necessary step, really, to get the balance sheet aligned with today's market realities and give everyone a cleaner baseline for future results. It's like taking your lumps now, but it cleans up the books.
Clearing the decks. That makes sense. Taking the hit now for a cleaner future. So how do these big strategic moves and this accounting cleanup actually play out across their different lines of business? Let's dive into that. Transitioning to slide 3, the engine room business segment performance.
The engine room business segment performance.
Right, because Tilray isn't just a cannabis company anymore, right? They position themselves as a diversified consumer packaged goods company. And their overall performance is really the sum of these distinct parts. Q4 really shows a company in transition, I think. Strong growth in some spots, offset by, strategic repositioning elsewhere. So first up, let's talk cannabis. Revenue here was $67.8 million. That's actually down 5.7% year over year.
But
this headline number kind of hides a really important strategic shift. The company is deliberately pulling back from the super competitive, often price-pressured Canadian market.
makes sense.
Yeah, and instead focusing on higher margin international medical cannabis sales. And that pivot, it seems to be working. International cannabis revenue surged by 71% in the quarter.
71%. Wow.
Yeah. And you see the impact on profitability, too. The segment's gross margin expanded significantly, up to 44% from 40% a year ago. So that shows a clear focus on profit over just, selling volume. Okay, next, beverage. This segment had a tougher quarter. Revenue declined 14.5% to $65.6 million, and the gross margin really took a hit, collapsing from a pretty healthy 53% down to 38% year over year.
Ouch.
Yeah. Management says this is due to something they call Project 420. For anyone not familiar, Project 420, bit of a playful name, obviously.
Yeah.
It's a strategic plan to streamline operations and basically rationalize their SKUs, their stock-keeping units, especially from the craft beverage brands they bought recently. This sounds like a classic turnaround play, doesn't it?
Absolutely. Absorb short-term pain, trim the fat, aim for long-term efficiency.
Exactly. Lower revenue and margins now, hopefully for a more efficient, profitable business later. And they are making progress. Tilray mentioned they've already hit $24 million in annualized savings towards their $33 million target for this project. So moving along.
Good sign.
Then finally, you've got distribution and wellness. Now, compared to the, let's say, volatility in cannabis and beverage, these businesses seem to be the steady pillars. The distribution segment, mostly in Europe, grew revenue by a healthy 12.9% to $74.1 million. It actually became their largest segment by revenue this quarter.
Interesting.
And the wellness segment also posted solid growth, 8.8%, hitting $17.0 million. These two seem to provide that steady stream of revenue and gross profit, probably helping to fund some of the bigger moves elsewhere.
Yeah, what's really interesting here, especially if you're listening and thinking about this company, is that investing in Tilray isn't just one bet on, say, Canadian weed legalization anymore.
Right.
You're essentially investing in a managed portfolio of different businesses, each with its own story. You've got international cannabis as the high-growth potential play with expanding margins. You've got the beverage business, which is, like you said, a turnaround story. Success there really depends on executing Project 420 well. And then you have distribution and wellness, providing that stable, maybe lower risk foundation. The company's overall success really hangs on managing this mix effectively and making these shifts pay off.
So it's the combination, the portfolio management, not just one single thing. That's a really helpful way to frame it. Now, with all these moving parts and strategic shifts, how solid is their financial footing? Let's move to our next section. Now for slide 4, financial strength and shareholder rewards.
Financial strength and shareholder rewards.
Okay, let's shift gears now to the balance sheet. Because, in an industry like cannabis, volatile, needs a lot of capital, having a strong balance sheet can be a huge competitive advantage. And it seems pretty clear Tilray's management has prioritized financial stability.
That's exactly right. If we look at their balance sheet health, the company finished the fiscal year with a pretty strong liquidity position. They had $256.4 million in cash and marketable securities on hand. Management even specifically called this out, saying this cash balance gives them great flexibility for strategic opportunities, basically money to make moves.
Oh, good cushion.
Yeah. And another key thing is their debt-to-equity ratio. This tells you how much they rely on borrowing versus owner funding. Based on their balance sheet at the end of May 2025, Tilray has total liabilities of about $585 million and total equity of $1.49 billion. That gives them a low debt-to-equity ratio of just 0.39. That points to a conservative capital structure, definitely lower risk compared to a lot of their peers in the cannabis space who are, frankly, loaded with debt.
Right.
And reinforcing this, management really hammered home their focus on debt reduction. They actually cut total outstanding debt by nearly $100 million during fiscal 2025. So paying down debt is clearly a priority.
Okay, so focusing on stability. What about shareholder returns then? When we look at capital allocation, the press release didn't mention anything about a dividend policy or a share buyback program.
No, nothing there.
Instead, it seems like the capital is going towards strengthening that balance sheet, paying down debt, like you said, and funding these strategic growth initiatives, which of course contrasts with that 23% year-over-year increase in the share count we talked about earlier.
Right, the dilution.
Which suggests that, historically at least, they used issuing shares to fund operations and acquisitions.
Yeah, and it raises an interesting point. Why this fortress balance sheet strategy now? Well, in an industry where, as we said, lots of competitors are struggling with high debt and finding it hard to get more capital, this financial strength becomes a really strategic asset for Tilray. It ensures they can weather industry downturns, which can definitely happen in new markets like cannabis, but it also gives them what finance folks call dry powder.
Dry powder, yeah.
Yeah.
Cash on hand.
Exactly. Cash ready to deploy for opportunistic acquisitions or investments, maybe when rivals are weak or distressed. So for you as an investor looking at Tilray, the investment thesis isn't really about getting quick cash returns through dividends or buybacks right now. It's more about them building a dominant long-term position by using financial stability as a weapon, essentially. They're playing the long game.
Building a fortress for the future. Surviving the battles now to win the war later. Makes sense in a tough industry. Okay, so let's look at what management is actually saying about where they go from here. Our final segment. Moving to slide 5, the road ahead management's outlook and key takeaways.
The road ahead management's outlook and key takeaways.
All right, so we've looked back at the numbers, we've analyzed the strategy, checked the financial health. Now let's turn to what management is saying looking forward. This is where they signal their confidence, or lack thereof, in the strategy and what they expect for profitability next year.
And what's pretty significant here is that the company actually issued guidance for their fiscal year 2026. They're expecting to achieve adjusted EBITDA somewhere between $62 million and $72 million.
Okay.
Now, that forecast represents growth of about 13% to 31% compared to the $55 million they just reported for fiscal 2025. So that's a pretty clear signal of strong belief internally that their focus on efficiency and those higher margin sales will actually produce tangible results on the bottom line.
And the CEO, Irwin Simon, his strategic vision seems to back this up. He outlined 3 core pillars for their long-term strategy. First, international growth, using their global setup and distribution network to really lead as the global cannabis market hopefully expands.
Makes sense, given that 71% growth number.
Exactly. Second, innovation. Committing to innovation across their brands, they even mentioned AI initiatives, saying it differentiates them from competitors. And third, diversification, looking for key growth opportunities not just in cannabis, but also in beverage and wellness. It's that whole portfolio approach again.
Right. So if we try to boil down the key takeaways from this whole deep dive, I think there are a few main points for you, the listener. First off, that Q4 revenue miss wasn't just a simple miss, it was a deliberate pivot. It came directly from that strategic choice to get out of lower margin Canadian cannabis products. And that move actually boosted cannabis gross margins up to 44% and helped lead to that surprise adjusted EPS profit.
Right, the zeros and 2 cent.
Yeah, exactly. Second, that billion-dollar write-down, it's painful, yeah, but it's a necessary reset. That massive $1.27 billion gap loss is fundamentally a non-cash accounting thing. It cleans up the balance sheet from that Afria deal whose value was tied to U.S. legalization hopes that haven't panned out yet. This should mean cleaner, more representative gap earnings going forward.
Hopefully easier to understand numbers next time.
Hopefully. Third, the future for Tilray looks increasingly international and efficient. Their growth story really seems to hinge on 2 things now. Expanding that high-margin international cannabis business, remember, 71% growth this quarter, and successfully executing that Project 420 cost-saving plan in the beverage segment. And finally, that confident guidance really signals a potential turning point. Management forecasting double-digit growth in adjusted EBITDA for fiscal 2026 is their clearest signal that they believe all this current strategic pain, these tough choices, are expected to lead to significant future gains in core profitability.
Okay, so pulling it all together, what's a final narrative for you as a listener tracking Tilray?
I think Q4 shouldn't just be seen as a simple revenue miss. It looks more like a pivotal, maybe kind of messy, but definitely strategic chapter in their transformation into this diversified consumer goods company. Management is making some tough but deliberate choices, cutting less profitable ventures, taking the accounting hit from past optimism, and really shoring up the balance sheet. This repositioning, focused on high-potential international cannabis in a leaner beverage unit, is backed up by that confident forecast for better profitability ahead. So the story of this quarter seems to be about sacrificing some of today's top-line numbers for what management clearly believes is a more sustainable and profitable foundation for tomorrow. And that really wraps up our deep dive into Tilray Brands, Inc.'s Q4 2025 earnings. As you can hopefully see, by using a consistent framework like this to analyze earnings, you can get beyond those scary headlines and really start to understand the underlying drivers, assess the financial health, and grasp management's outlook based on the info they provide.
It's a process you can use again and again to build a deeper understanding of your investments. Now, before we sign off, just the usual quick reminders. This report is for informational purposes only. It is definitely not financial, investment, legal, or tax advice. Please, always do your own research and consult with a qualified financial professional before making any investment decisions. And also a note, this report was generated using an artificial intelligence model, integrating official company data with public market information. We strive for accuracy, but errors can happen, so always verify key information independently. You can find the full disclaimer in our show notes. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.